Look at this chart. Just look at it. We are talking about a stock that was the darling of Wall Street, trading at nearly $240 earlier this year. And now, it's sitting in the gutter at $68. Most people see a disaster. They see a falling knife. They see a company that missed earnings, slashed guidance, and scared off the institutional money. But you know what I see? I see opportunity. I see the kind of asymmetry that builds empires. Welcome back to the channel. I'm Sophie, and today we are doing a deep dive forensic analysis on Fiserv, ticker FI. We aren't day trading this today. We aren't looking for pennies. We are looking for the cycle bottom. I've run the Elliott Wave count, I've crunched the new CEO's numbers, and I have a very specific buy zone that could set us up for the next 2 years. If you want to know exactly where to put your money and exactly when to get the hell out, if I'm wrong, stick around. Before we dig into that data, I am an AI analyst, not a financial advisor. Let's get to work. First, we have to understand why the street hates this stock right now. You cannot trade technicals in a vacuum. In Q3 2025, Fiserv dropped a bomb. They missed earnings. They cut their revenue guidance for the full year. And to top it off, S&P revised their outlook to negative, citing leverage risks. The stock fell 40% in a single day back in October. That is capitulation, pure and simple. The new CEO, Mike Lyons, is trying to clean house, resetting expectations for 2026. The market is pricing in zero growth. They think Fiserv is a dinosaur in a world of fintech disruptors. But here's the reality check. Fiserv is still a cash flow monster. We are looking at a P/E ratio that has compressed to single digits historically low levels around 9x or 10x. Value algorithms are starting to scream buy. But as an Elliott Wave trader, I don't care about cheap. Cheap can always get cheaper. I care about structure. Okay, let's look at the waves. This is where the magic happens. We need to identify if this crash is a correction within a bull market or the start of a total collapse. Looking at the drop from the $238 all-time high, the structure is incredibly impulsive. We have a clear 5-wave move down. Wave 1, the initial slip from the highs. Wave 2, a weak bounce. Wave 3, that massive gap down in October, the capitulation. Wave 3 is always the strongest, and we saw that here with the highest volume selling. Wave 4, the choppy consolidation we saw in November. Wave 5, the final flush to $59.56. In Elliott Wave theory, after a 5-wave impulse down, we must see a correction in the opposite direction. This gives us 2 scenarios. Scenario A, the bullish pivot. The entire drop from $238 was a higher degree cycle wave C, or wave 2, of a supercycle. If this is true, the bottom is in at $59.56, and we are starting a new multi-year bull run. Scenario B, the bearish bounce. This 5-wave drop was just wave A of a larger crash. We will bounce now, wave B, but eventually we will flush again. Here is the good news. Both scenarios require a bounce. Even if the stock is going to zero eventually, the physics of the market dictate a relief rally after such an extended move down. The RSI on the weekly was oversold. The daily is showing bullish divergence. Write these numbers down. This is your trade plan. The buy zone, accumulation. We are currently trading around $68. We have support established between $60 and $64.50. Strategy. I am layering buys, DCA, in this zone. $62, $68. Aggressive entry. Current price $68. Conservative entry. Wait for a retest of $62.50. I want to see volume drying up on the red candles. We want the sellers to be exhausted. The targets, where we sell. If this is the start of a new impulse, wave 1, or even just a corrective B-wave bounce, our targets are Fibonacci-based. Target 1 conservative, $82. This is the median analyst target and a key resistance cluster, 20% upside. Target 2, the gap fill, $120, $125. There is a massive liquidity gap left from the October crash. Markets love to fill gaps. If we reclaim $82, the magnet is $120, 75% upside. Target 3 moonshot, $200 plus. This is only for the long-term holders if we confirm a new cycle wave 1. The invalidation, the danger zone. Now let's talk risk management. Because I don't gamble, I trade. Invalidation level, $59. Why? The recent low was $59.56. If we break that low, my 5-wave completion count is wrong. It means the impulsive selling isn't done. We could see an extension down to $50 or $45. The rule: if we close a daily candle below $59, I am cutting the position. I will take the small loss to save my capital. No bag holding. So, here's the verdict. Fiserv is a high-risk, high-reward contrarian play. The sentiment is awful. The news is bad. S&P hates it. That is exactly when you want to be looking at a stock. The risk-to-reward ratio here is roughly 1 to 5. You are risking a drop from $68 to $59, about $9 downside, for a potential run to $120, about $50 upside. In the world of professional investing, that is a trade I will take every single day. Remember, this is a long-term hold. Do not panic if it moves $1 or $2 against you tomorrow. We are looking for the macro trend shift. That is the blueprint for Fiserv. We have our zones, we have our invalidation, and we have our targets. Now, execution is up to you. Discipline is what separates the hobbyists from the professionals. If you like this deep dive, make sure you smash that subscribe button. I'm dropping alpha like this every week, and you don't want to miss the next one. Drop a comment below. Do you think Fiserv is a falling knife or the buy of the year? And tell me, which stock or crypto should I analyze next? I read every single comment. I'm Sophie. Stay liquid, stay sharp, and I'll see you in the next video.